This
meeting is being recorded.
You can mute. You can mute.
Yes.
Yes, you can mute. If you are not using the mic, you just mute.
Okay.
Okay. I'll go straight forward and I do my opening remarks as we wait for the others, because this video I will upload it on YouTube. So hello guys, and welcome to this class. It's a business data analytics class, and I hope you had a wonderful day. So today we'll be covering project evaluation using Microsoft Excel spreadsheet. And to our YouTube viewers, if you are new to this channel, I recommend that you subscribe if you find this content it's interesting. And also for our returning subscribers, please make sure you share out the channel and make people. I want the channel to grow so that it motivates me to see that the channel is growing. Also, we'll be posting videos according to how the channel grows. Like we set a target of, like we want our subscribers to reach this level. When we reach that level, we upload the new video. So subscriptions will facilitate videos coming in so fast. Okay, we'll jump straight into the video, into the class again. And if you are watching this video or you are in this class, it means that you have a background knowledge about project evaluation. And so we just go straight into the questions. This is the practical part of business data analytics. I will not go into the theoretical part so much, but let's start the question. So the questions read this way. We are evaluating a 4-year project with an initial investment of shillings 10 million on January 2023. The following are the cash flow characteristics. You have been given there the data and the cash flows. The discount rate is given as 8%. Required. Calculate the NPV and XNPV of the project and hence determine whether the project is viable. Highlight the cost of the difference between NPV and XNPV. Explain which one would you use in your analysis. And part B of the question, calculate the IRR and XIRR of the project and hence determine whether the project is viable. Highlight the causes of the difference between IRR and XIRR. Explain which one would you use in your analysis. So let's start. This one is a very simple one. It doesn't take a lot of time. Okay, we'll start with part A, the NPV. So we'll come here down. NPV equals, you start with an equal sign, then you write NPV, the formula, you press tab button, you have been required the rate. So the rate is 8%. You key in that one and the values. So the values you have been given up here. And when you are doing NPV under this Microsoft Excel, we tend to exclude the cash outflow. So we start from 30 June 2023, the 2750. That is the values under the formula. We take all that one down. We close our brackets. Then we add the cash outflow, because NPV is present values minus flow. Oh. Then you press Control Enter. Then it gives you an answer there. And you can remove the decimal places to 2 decimal places. You see the project has a positive NPV, so it's viable. We'll go to XNPV. Come here. We'll start with a equal sign. XNPV. And so for XNPV, it's a little bit different. So also it has the rate. You see here the formula, it's requesting the rate. So the rate is 8%. And you've been asked the value. So under XNPV, we will take all the values. We will not exclude the first value. So here we take all this way, comma, and then we've been asked the Sorry, that one I've not taken the full one. Sorry. Then you put a comma, then the dates, you just take the dates. There you find it. Let me pin this one up. You see the XNPV is greater than NPV. So you have been asked part 2 of the question. Highlight the cause of the difference between NPV and XNPV. Explain which one in your analysis and why. So NPV considers that the cash flows occur on a regular time interval basis, like annually, let's say annually. NPV focuses on annually. But when you come on XNPV does not consider cash flows to be occurring in a regular time interval. So that's the difference. And in your analysis, why? So me, under this analysis, we'll use XNPV because when you look at the dates here, when you see the dates are not in a annually format, so we will use XNPV. Then we'll go to part B of the question. Part B of the question is IRR and XIRR. So let me write those ones here. So IRR is very simple, equal sign, IRR. You press tab button, you have been asked the values. So the values under IRR, we just take all the values this way, and we close our brackets. It's not a must to put a guess here. You know, the computer is very genius. So you just leave it that you don't guess. Even if you guess, there's no difference. So you close the brackets and control enter. You see it's 12%, and you like to increase the decimal places to be sure of where it is. Let's say 2 decimal places. And XIRR, you press tab button, the values. So you just take all the values, you press comma, and you take the dates. We close our brackets, control, close our brackets. You don't have to make a guess, control enter, and I change it into percentage. You put it in 2 decimal places. Also, the difference is the same, what I've explained up there. The difference is the same. It's because our cash flows are not occurring on a regular time interval, isn't it? So we'll go to our second question. And this question was in the last exam, the December 2022 examination. This question was there, and you see it was carrying 20 marks. Okay, even the next question also, this one was in the December 2022 examination. This one is a bit long, so I'll go to question 2 directly. Mr. Jane Wakwa is a marketing director of Vuma Limited, a company that makes and sells electronic devices. The company is considering the launch of a new mobile phone model branded Trex. The available data is not fully reliable, though Jane still feels that she can make a recommendation on whether or not to launch Trex. Additional information. Trex is estimated to have a shelf life of 5 years. Let's say that's the useful life. Trex will require purchase of a machine that will cost 100 million at the end of year 2022, after which the machine will be sold for 20 million. That's the cost of the machine and the salvage value. The selling price and cost of structures of Trex for the year 2020, for the first year 2023, with the expected inflation factors as follows. Shillings, their inflation. You've been given the selling price, material cost, direct labor, incremental fixed cost. Question additional information number 4. The company is eligible for capital allowances, depreciation for tax purposes at a rate of 25% on reducing balance. At the end of the project, the machine will be sold. Any gain or loss on disposal will be considered for tax. That is capital gain tax. The tax rate on income and capital allowance is at the rate of 30%. Assume that tax for the given period is paid the same year. The project will require an initial investment in working capital of 20 million, which will be increasing by 5 million at the end of each year to cater for general inflation. The amount together with the periodic increase will, however, be reverted at the end year project. That is the recovery of working capital. And experience has shown that the demand for new products is not exactly known in the year, but tends to be stable thereafter. Jen has come up with the following estimates of demand of the year 2023. So there we've been given probability expected sales units, 30%, 40, that's just probability. Jen is expect an initial increase in demand in the year 2024 of 25%, then a decline of 50% in the year 2025. The level will remain same till the end of the project. Vuma Limited has a real weighted average cost of capital, WACC of 8%, and the general inflation is expected to be 4%. Due to the risk of the project, Jen feels that the relevant nominal WACC should be increased by 3%. Required, compute the following: the weighted average cost of capital to be used to evaluate the project. So here, if you don't have a background knowledge of project evaluation, this question will tend to mess you up a little bit, but it's very simple. So part A, what we will use, we always use the nominal WACC. We don't use the real WACC. And the real cost of capital does not incorporate inflation. That's the difference. You see in our question, there up we have been told about inflation. So we will not use the real weight WACC because the real WACC does not incorporate inflation, but the nominal WACC, incorporates inflation. So that's what we will use in this question. And there's always a bridge between the real nominal and the real and the nominal. So the bridge is the Fisher's model. So the Fisher's model is very simple. The Fisher's model is, I think I'll write for you. It's very simple. Let me just write here. Real WACC, let me press is equals to nominal minus inflation. Isn't it? Yes. Let me widen here. So the real WACC is equals to nominal WACC minus inflation. So what we'll be using in this question, we'll use the nominal. And we, under additional information number 9, we've been given the real cost of capital. But they say due to the risk of the project, Jens feels that the relevant nominal WACC should be increased by 3%. So to get nominal, it will be real plus inflation, but now we'll add 3%. We'll not use the 4% due to the risk of the project, isn't it? So is equals to 8%. Sorry, 8 plus 3. This 3 what we should increase with 3%. Control enter. So that's it. So we go to part B of the question. So the part B of the question now is the question itself. That one was very easy. Part A, you see part B has 15 marks. So they say that this company, let me go up here. This company will require to purchase a machine at the cost of shillings 100 million in the year 2022. So that's the year we're beginning with. We come here, we do control bolt 2022 tab, control bolt 2023 tab. And we've been told that it goes for 3 years. So Excel has series of fillings. When I do 2022 and 2023, I do this way up to 2027. So this is year 1, year 2, year 3, year 4, and year 5, isn't it? I'll do this way. Alt HBH to put there. So we'll start with the units. So the like how we were saying the expected revenue. So here will be expected sales units. So expected sales units. Go back here up. So you have been given the probability for the year 2023. So we'll come. It will be just simple. For the year 2023 equals, you go up here, you open brackets, the 30%, you can follow up here, you can follow from up here, the 30% times 40, close bracket, shift plus 40%, no, okay, no, let me open brackets, times 30, shift close brackets, open brackets, times the 10, shift close brackets, control enter, then you control backspace to jump to the active sales where you are. You do control backspace, you see here. So we have found to be 27,000. That's the expected sales unit. And Jen expects an initial increase in the demand in the year 2024 of 25%. So 2024 will be by 25% equals the 2023 times, so the 25%, it will be 1.25, isn't it? Control enter. Then we come to 2023, and then a decline of 50% in the year 2025, 2025. So equals 2024 times, now it will be 0.5, isn't it? 0.5, because it's a decrease of 50%. The 2024 will take it as 100%. Control enter. The level will remain constant till end year. So we'll come here. It will be constant, isn't it? Equals this one. Control enter. Then we feel that it will be the same, isn't it? Now from there we have now found the expected sales in units. So we'll prepare an income statement, a simple income statement. So I'll control bold to bolden it. Income statement. I'll do this and I'll merge and center so that it's there in the middle. So we'll go to, we were given the sales, isn't it? So we come here, and you see the good thing of Excel is you don't have to write even everything. You see, we've been told this one this way. We come, we collect it, Control C to copy. You come, then you do Control V, then you change this one to be, let me say, revenue. Isn't it? Yeah. So we come, we've been told the sales per unit, material cost per unit, and direct labor per unit. So to make this thing a little bit simpler, we will work in, let me say, we'll work in thousands. So now we'll take our selling price to be 5, material cost to be 2, direct labor to be 1, and this one to be 0.5 to make it a little bit smaller. So like you can write somewhere there in thousands. So it will be equals our units times, that one was 5, isn't it? 5. The selling price here, the selling price. control enter, control backspace to jump to the active cell. Material cost equals the units times, that one was, I've forgotten again. That one was 2 times 2, control enter, control backspace. Direct labor cost equals the unit sold times 1, that was because it was 1,000. And the incremental, but they have been told it excludes depreciation, isn't it? Is equals to 0.5 times the unit sales. Yeah. Remember, this is under year 2023. Under year 2023. So we've been told about inflation. The selling price, the inflation is 2, 4, 5, and 10, isn't it? So that's how the inflation will be growing. So 2024 it will be equals to 2023 times 1.02. The growth in inflation is 0.02. Okay. And then for material cost is equals to this one times, what was it? Times 4 or what? Times 4. So it will be 1.04. Direct labor cost will be direct labor cost. You must press is equal sign to calculate a function in a cell times 1.05. And our incremental fixed cost, it will be equals the 2023 times 1.1, because it was going at 1 point, it was going at 10%. We come, we drag this one down, then we fill out. Then after here, we go to, what is next? We go to depreciation, of course, depreciation. So let me write here depreciation. I'll show you how you can write dep and it writes depreciation. This class, I'm very good at Excel. So depreciation was where? The company is eligible for capital allowances, depreciation for tax purposes at the rate of 25% on reducing balance. So let's do this. Let's not do fast depreciation. We'll do it later. We just fill out, because I'm going up, I'm coming down. Let me just write the whole question up until down. Then after depreciation, we go to debit. Then we go to tax. After tax, we go to profit after tax, and then we add depreciation. We get our operating cash flows. Then we come to something called investment statement. So this investment statement is where now I'll get the fixed asset so that I can do on it depreciation. Control Bolt. You do this, you merge and center. So we come to fixed asset investment. So the asset is being invested in the year 2022, and it had 100 million, and we are working in thousands, so it will be 100,000. Yes, and investment is good because it's money going out. We do it in a negative format. Then we come to working capital investment. The working capital, we are investing how 20 million or what? Yes, the working capital investment of 20 million, which will be increasing by 5 million at the end of each year to cater for so working capital investment, it will be equals 20,000, we're working in thousand, and we've been told it will be increasing by 5 million, so it will be equals the that one shift plus, no, we can't add, we'll do minus 5,000 because we can't add on a negative. It will be increasing by 25. Yeah. Then we do something called working capital changes. Don't confuse this one with this one. This one is just how it will be going, but the working capital changes is what goes in the project cash flows. So it will be equals. No, yes, it's good. Equals the current one minus the previous one. It will be going by 5,000 that way. Then we do something called terminal benefits. I know you are familiar with this term. And now we were told about capital gain tax, had forgotten. Then from there we get the project cash flows control bolt. So now we come to do the depreciation. Here, in fact, we've forgotten here, under terminal benefits, first we have the 20, what was the salvage value? 20, was it 20 million? Yes, the salvage value was 20 million. You see, I just want to, sometimes it's good to confirm so that I don't write something that was not there. 20. Yeah, so we do depreciation. So depreciation, we have been told the cost is 100, and we have a salvage value of 20 million. So it will be, now I'll start with the opening bracket. I'll put negative. Sorry, you must start with equal signs, then bracket, negative, that one, minus the salvage value, close the bracket, times, we are told 25% depreciation. The first year it's 20 million. So let me say this 100 minus 20, 100 minus 20, it's 80. I'm saying that so that we can go a little bit faster. Equals, open the bracket, so it will be 80, 1, 2, 3, minus the 20, close bracket, times 0.25. Go to the next one, equals, open bracket, 80 minus the sum of these two, close again bracket because I had opened two brackets, times 0.25. We go to the 2026 equals, open bracket, 80,000, 1, 2, 3, minus the sum of, we open another bracket, this sum, close bracket, then close again bracket, times 0.25, control enter. Now we go to the last year, equals, open bracket, 80, 1, 2, 3, minus sum of Just key in some, then press tab. If you are doing it by me, times 0.25, control enter. So that's the depreciation. So we come to the earnings before tax. Let me do this. Control B to bolden. It will be equals. So our revenue, this is our income, isn't it? It will be equal. So this one minus sum tab, the sum of now our cost, close bracket, control enter, control bolt to bolden it, alt H BP to put a top border, then you drag along. You come to tax equals, we were told our tax was 30%, 0.3, control, let me do this point minus 0.3, so that it comes when it's a negative, to make my work very simple. Profit after tax, you come here, you control B to bolden, come, alt, you press alt equals, you know, it jumps up to up here, but you must be very careful because I'm only adding these two. Yeah, control enter, control B to bolden, and I will drag it along. Then you add a depreciation equals. So our depreciation is just up here, control enter, and you just take it like that and you drag along. It copies that along. You see, even here, it's this one, it's just this one here, the depreciation. Yeah. Then operating cash flows, control bolt, it will be equals the profit after tax plus our depreciation. Control enter, control B to bolden, alt HBP to put a top border, and you drag that along. And you come now to, sorry, you come to our terminal benefits. You see, we had we did this 20,000, but we also have the working capital recovery. So it will come correct here. You can correct from up here, shift plus. There are recovery in working capital. That's why we did a working capital investment, because we are told that the accumulated will be recovered at the end of the period. But you see, it's in a negative, so we'll put a negative before, and we take that one because it. Wait first. Control Z to go back. Control Z to go back. We had forgotten the equal sign. You must also know these things. Like when you mess, you do Control Z. You go back to where you are. Equals. Shift plus 45. The 45,000. Let me just hard type it in because it's dynamic. It makes it change. So we come to the capital gain tax. So our capital gain tax, it will be our salvage value minus what was the book value, what was the book value minus the salvage value. So it will be equals. So we were told it was 20,000. Let me write here first. We were told the salvage value was 20,000, but also we had depreciation, isn't it? And let's also find our total depreciation. Alt equals, control enter. So this is the accumulated depreciation. You see, the capital gain tax is always taxed on the gain. It's not taxed on the 20,000. That's why we are doing this. We want to see the gain that was made. So, and this 20,000 is the salvage value. So it will be from 80,000. 80,000. Control enter equals this one minus this one. Control enter. So this is what was above it. So this one, our capital gain tax equals point -3 shift times what was above it. Control enter. I'd forgotten to put the equal sign. Sorry. Sorry, let me write. Had written badly. You start with -0.3 times this one. That is the capital gain tax. Let's make it bold. And also the terminal benefits, let's make them bold. And also these two, we make them bold. What we are making bold is what we are adding up to get our project cash flows. Control bold. So here it will be equals the fixed asset investment plus working capital. You see, so we just restart to, you see the my Zoom is periodic, it's not upgraded. So it runs out at 40 minutes time. So it's time let's just log in again because it's 2 minutes. Let me just check these 2 minutes to communicate to my YouTube viewers. We are coming back, don't worry. We are coming back to continue with our question because you see, I want also viewers to increase. Let me just say, like, we also have physical classes, not physical classes. We also have virtual classes. This is for YouTube, guys. We have virtual classes online on business data analytics at a very reliable price, and we also have the notes and the questions. So if you are on YouTube and you would like to join our classes, I'll put my link of WhatsApp in the description box down below, and you can communicate to me if you are interested. Thank you for the video. See you in the next class. So let's log out and we log in again.